On the international tax side, the Senate bill fulfills the objective of making the United States more competitive as a headquarters location for multinational companies. This increased competitiveness largely is achieved through a complete exemption from U.S. tax for distributions of the future foreign earnings of a foreign subsidiary to its U.S. parent. With respect to the already accumulated earnings of foreign subsidiaries of a U.S. parent, the Senate bill would impose an immediate tax on those earnings, but at significantly reduced rates and with the opportunity to spread the tax payments over a number of years. Curiously, this so-called repatriation tax apparently could apply in some circumstances to significant U.S. shareholders of a foreign company that are individuals or other taxpayers that would not be eligible for the dividend exemption going forward. Now, looking at the U.S. earnings of multinational companies, the Senate bill includes some international provisions intended to limit the ability to reduce U.S. tax on those earnings using arrangements with foreign affiliates. This would include an enhanced earnings stripping limitation on interest deductions in future years.
One of the selling points of MLPs under current law is that their income is more lightly taxed than that of public corporations. And that's going to continue to be the case under tax reform. The rates for corporations will go down, but the rates that apply to MLPs will go down as well. So we'll maintain that competitive advantage.
The Senate bill, like the House bill before it, backed off of earlier proposals that would have dramatically changed the tax treatment of deferred compensation. So under both the Senate and House proposals, Section 409A would remain in place in its current form. A significant change to the treatment of tax deductions for compensation paid to certain executives of public companies is included in both the Senate and House bills. Under this provision, payments to executives such as the CEO, CFO, and the 3 highest paid executives included in the proxy would not be deductible to the extent the compensation exceeds $1 million per year. This $1 million limitation has been in place since 1993 under Section 162M and has never been adjusted upwards. Under the new proposal, there would be no exception from the $1 million deduction limitation for performance-based compensation, such as stock options, cash bonuses, performance-based share arrangements that have previously been permitted to be structured as deductible compensation. Also, compensation paid to an executive after separation from service would likewise be subject to the $1 million compensation deduction limitation. There is an exception for certain arrangements that are already in place, so companies will want to be very careful to evaluate and assess these arrangements and make sure that they don't inadvertently lose the deduction that could have been available. The Senate bill will reduce the corporate tax rate, which will cause many companies to consider accelerating their deductions into the current tax year. There are some unique considerations about accelerating compensation income and deducting it in the current year, so companies will want to be careful to evaluate these in connection with that review.